Global equities rallied on the backdrop of increased bets for these upcoming US Federal Reserve rate cuts, and as well as bad data is considered as good data yesterday. That also increases the odds of this US Federal Reserve rate cut bets for the December FOMC meeting, where retail sales and US consumers confidence data came in below expectation. The US dollar index tumbled yesterday and broke below the 20-day moving average, reinforcing a positive feedback loop back into the global stock market. Very good morning to all. I'm Kelvin here. Welcome back to your daily dose of market insights. Today will be the Wednesday, the 26th of November, 2025. So as usual, before we kickstart the gist of today's daily dose, let's have a quick look at the disclaimer first. Leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exit deposits. This presentation is for general information purposes and is not investment advice. Past information is not representative of future results. All right, so as usual, let's have a quick recap what has taken shape yesterday in terms of the relevant news flow, economic data releases that has a significant impact on the intraday movement of these broad-based cross-asset classes that we cover on a frequent basis. So I mentioned earlier, good data, bad data is equivalent to good news for the global stock market, because yesterday two key US data came in below expectation. So what are they? So let me very quickly share with you my screen on this data over here. Right, so let me go to the economic calendar. Right, so yesterday we do have retail sales, which is very important. Why retail sales is important? Because close to 3/4 of US economic growth is driven by services activity, and retail sales is a subset of services activity in the US. So retail sales data for the month of September, so this is slightly delayed due to the historical government shutdown that has taken shape about 2 weeks ago that finally managed to get resolved. So now we see a slew of government compiled data being released to the public. So retail sales month on month for September came in worse than expected. So market is expecting 0.4%. It came in at 0.2%, way below 0.6% that was also printed in the previous month of August over here. So if you stretch it out from a year-on-year basis, it also came in below expectation as well, 4.3% year-on-year, where trading economics pencil in a forecasted rate of 3.9%, and also way below what market is expecting at 5%. And most importantly is the forward-looking up-to-date consumer confidence data as compiled by Conference Board. So we know that consumer confidence data are soft data, that means it's based on survey, which has a leading element as compared to backward-looking government compiled data based on the past month. So forward-looking consumer confidence, Conference Board consumer confidence for the month of November came in at 88.7, way below market is expecting at 93.4, and also way below the previous October month of 95.5. And this 88.7 is the lowest level since April this year. So we know what happened in April this year. April this year is actually driven by a key risk event, which is the aftermath of the announcement by the US White House administration global reciprocal trade tariffs. So if you look at the chart of the consumer confidence index as compiled by this Conference Board, it plummeted. Yet a November figure plummeted to the lowest level since April. And if you look at in a last 3 months or so, it has been doing a series of lower high, and also breaking below this key support level, retesting this key major support level that's being seen in the aftermath of the COVID-19 situation way back in 5.5 years ago, which is March 2020. So what we could see over here is a K-shaped situation right now. Real economic situation is getting very bad. However, global stock market continues to rally. So why global stock market continues to rally is because of that ongoing interest rate cut cycle that has been reinforced nevertheless by the biggest major central bank in the world, which is the Fed. So if you look at the CME Fed Watch tool right now, market participants in the Fed Funds futures market has now priced in a high odds of 84%. So yesterday was around 80%. It jumped by 4 basis point higher right now at 84.3. Right, still recall that last week the US stock market wobbled, on top of Nvidia's negative feedback loop. Another reason why the US stock market last week was rather weak because of a low odds of a interest rate cut in the December FOMC meeting. So last week it was about 30 to 40%. Now the odds has a big reversal back up to 84%, making it a high chance that the US Federal Reserve got to do more right now by cutting rates for the third time this year to bring it down lower to 3.5% to 3.75%. So that's 84.3 chance right now. And if you look back, if you look forward, pardon me, not back, if you look forward down the calendar for future dates ahead in next year, 2026. So market participants also are looking for a high chance of 3 interest rate cut to come in 2026. So a 79% chance for the next cut, I would say for the fourth potential cut to come in at the 29th of April 2026 FOMC meeting, 79% chance, and a 85% chance for the fifth cut to come in on the 29th of July 2026 meeting, and the sixth potential cut before the year ends in 2026, 76% chance to come in on the last meeting of 2026, which is the 9th of December 2026 meeting. So net overall, potentially another 3 interest rate cut of 25 basis point each for in 2026. At the end of the year of 2026, the Fed funds rate potentially will be at 2.75% to 3%. Right, so that actually kept the liquidity situation in the US to increase and potentially globally as well, given that the Fed has a significant influence on a wider scale from a global market perspective. So that being said, it causes the US stock market to rally for the third consecutive session, which we got to respect the current animal spirits over here, bullish animal spirits. So yesterday, the Dow Jones Industrial Average outperformed due to the steepening of that US Treasury yield curve, given the fact that the 2-year Treasury yield fall more than the 10-year Treasury yield. Lisa talk more about that. So that is actually in favor of the US financials sector, which has a higher weightage in the Dow Jones Industrial Average. So the Dow Jones Industrial Average up 1.4% outperform, and also the top performer is the nevertheless is the small cap Russell 2000, which is up by 2.14%, given the fact that the Russell 2000 has a very high sensitivity to the interest rate prospect in the US. So if the Fed has a higher chance of cutting rates, that will potentially benefit the Russell 2000 from a financial leverage standpoint, given the fact that majority of the Russell 2000 component stocks has a much more higher leverage balance sheets as compared to those mega cap stocks that are being residing inside the SPX 500, the Nasdaq 100, as well as the Dow Jones Industrial Average. So the SPX trail behind with 0.9% over here, or 0.91, and yesterday's underperformer surprisingly will be the, not surprising, in fact, is the Nasdaq 100 due to the weak negative underperformance of Nvidia, which forms a significant bulk of the Nasdaq 100. We call it returns, driver of returns, given that it has a significant weightage in the Nasdaq 100, much more than the SPX 500. So if you look at the S&P 500 heat map, among the mega cap technology stocks that are riding on the coattails of this AI high productivity driven team play in the past 3 years, Nvidia plummeted by negative 2.6%. And the reason I shared yesterday why Nvidia plummeted is because of Meta, which is Facebook over here, Meta, which is up by 3.8%. So Meta, parent company of Facebook, has made an announcement that they are likely entering a deal with Google, parent company of Alphabet, to diversify their to diversify their data center services to run AI-driven model, given the fact that Google has now come out with this Tensor Processing Unit, TPU, a direct competition with NVIDIA Blackwell GPU. And Google TPU comes at a potentially lower cost, and also in terms of the end results as compared to Blackwell GPU is almost comparable. So that actually causes NVIDIA shares to plummet yesterday, down by negative 2.6%. But because the rest of the other mega cap technology stocks managed to close in the green, and that causes the major US benchmark stock indices to have a positive return as well. Nevertheless, and Nasdaq 100 has a lower return because NVIDIA has a much more significant weightage inside the Nasdaq 100. And even though NVIDIA closed down by negative 2.59%, towards by the end of the US session yesterday, it actually formed a bullish candlestick pattern and managed to close right exactly at the lower limit of the medium-term pivotal support that I highlighted earlier at 177.70. And yesterday, it formed a kind of a bullish hammer candlestick. Initially, the intraday drawdown was much more drastic. Let me share with you guys. Okay, where is the percent? Yeah. So taking into yesterday's close, the prior day close. So the intraday drawdown was a maximum negative 7.1%. So it closed at negative 2.6%, forming a bullish hammer candlestick, and the closing price is at 177.82, right exactly at the 177.70 key medium-term pivotal support. So that also created a positive feedback loop into the US stock market, despite it has a absolute negative close, daily close on NVIDIA. All right, so that's for the US stock market. Moving on, next will be the FX market. So like I mentioned, the FX market, the dollar strength has started to stall and showing signs of a potential bearish reversal, at least in the near term. So the dollar actually indeed slide yesterday. So that actually causes us, to me, to be very cautious on the euro and the sterling, where we flip to a neutral stance yesterday. And recall that we have a bullish bias on the Aussie dollar, which rallied as expected, and also the dollar yen continues to break below the 156 figure level. So later I'll touch more about the technical chart. All right, so what I could see is that the dollar continues to remains weak based on the 5-day rolling performance as of 26 November, and so further supported by the 2-year treasury yield premium shrinkage versus the rest of the world. So this is the 5-day rolling performance of the US dollar as of 26 November as we are speaking right now. So the dollar right now as we are speaking, based on the 5-day rolling performance, is the weakest against the Kiwi due to a RBNZ decision. Later I'll share with you guys. So this RBNZ, yes, it cut interest rate as expected by 25 basis points, but however, it actually mentioned that it's now coming very close to the end of its easing cycle, very much similar to what the RBA the Central Bank of Australia, RBA, announced in 2 weeks ago. All right, so let me share with you guys over here. All right, the RBNZ new forecast indicate a small chance of one more 25 basis point cut next year. So indicating that they are now coming very close or already ended their interest rate cut cycle. So causing the dollar to plummet against the Kiwi. All right, then back to the chart of the dollar index. So like I mentioned earlier, prior on Thursday, Friday, and Monday, we see a very we call it a small little candle body. We call it a what they call it in Japanese candlestick called spinning top, and this spinning top formed very close to the upper limit of a key medium-term range resistance level at 100.54. And yesterday it did a bearish Marabuzu candlestick down by negative 0.4%. And in today's Asia session, it has an intraday breakdown below the 200-day moving average and below the 20-day moving average, indicating ongoing technical weakness for the US dollar index. So implying that the recent 2 weeks of dollar strength that has taken shape since the low of 14th of November has likely stalled, and most importantly, the US dollar index may now start to float back down towards the middle part of this complex sideways range configuration that has taken shape since the low of 2nd of July this year. All right, it's a complex sideways configuration. Next two support level to watch as it's potentially float down towards the middle part of this sideways configuration at 99.25, followed by 99.66, which confluence with the 50-day moving average. So from a technical standpoint and from a fundamental standpoint, it seems to us that high odds that the 2 weeks of rally that was being seen on the US dollar since the low of 13th of November and late October over here, this rally has stalled on the US dollar index, and potentially right now we could start to see a signs of what I call dollar weakness in the short term for the US dollar index to float back down towards the middle part of this complex sideways range configuration as I'm presenting to you guys on the US dollar index chart right now. All right, and also with the US dollar index weakening, potentially we also now starts to see the fall in the US 2-year Treasury yield. So yesterday the US Treasury yield fall by 4 base, we call it 4 basis point over here, right? 0.044 basis point. So it fall 4 basis point to 3.47, and now retesting a key support level at 3.45 over here. So if break down 3.45, that will be the lowest level since April this year, as the broad-based downtrend of the US 2-year Treasury yield remains intact. All right. So given the fact that the US 2-year Treasury yield has a very high close direct sensitivity to the Fed funds rate level, and which means that has a very high sensitivity to the monetary policy decision of the US Federal Reserve. So yesterday, fall of the this US 2-year Treasury yield, it fall at this, where is it? Yeah, 4 basis point over here, and comparatively to the 10-year US Treasury yield, which fall by 0.033 basis point, which is much lower as compared to the magnitude of the 2 years. So that actually causes the 10-year, the US Treasury yield curve, taking account of the 10-year minus the 2-year, to actually steepen. So that actually benefit to the financials in terms of a steepening yield curve will potentially see the net interest income gets more firmer to the upside, and that causes the banks to actually outperform the other sector of the S&P 500. So what you could see over here is that if you were to look at the financials, this will be the financials. So if we were to go to the heat map of the S&P 500 yesterday, the breakdown of the groups over here, so we could see the financial is up by 1.27%, pardon me, outperforming the technology sector, which is only up marginally by 0.12%, 0.12%. 0.12% due to the underperformance of Nvidia yesterday. All right, and also the healthcare is up by 2.11%, and also the healthcare sector is also one of the biggest weightage inside the Dow Jones Industrial Average, but not in the S&P 500. All right, so that sum up the first segment of the daily dose. So let me now move on to the second segment, which is the intraday technical outlook segment. But before that, let me expand my screen, right, for you guys to have a better view of the charts. All right, so let us start with the FX market over here. So very quickly, let us start with the euro dollar. So still recall yesterday, euro dollar, we have no bearish conviction for it to retest 144.95 and even 1.1475. So we flipped to a neutrality stance. Price action broke above the upper neutrality limit at 115.50 and validate our bullish bias going forward, and also managed to surpass the 20-day moving average and did a retest before bouncing up during today's Asia session as well. So very clearly, the hourly RSI also continues to shape a series of higher low, okay, over here. And what we could see is that potentially it may start to form a minor bullish bottoming formation as being depicted by the minor swing low area of 5th of November and the minor swing low area that formed on the 20th of November to 25th of November. So with that, we will flip to a intraday bullish bias stance, flip to an intraday bullish bias stance for today on the euro dollar. So with any potential pullback that didn't surpass below our short-term pivotal support level that we have for today, 115.50, 115.40, bullish bias stance on the euro dollar. First resistance level to watch will be a zone 116 figure level, 116.15. A breakout above 116.15 will see a retest to this potential minor bullish bottoming configuration neckline resistance at 116.50, 116.60. All right, 1.1650, 1.1660. Only a bearish breakdown below 115.40 will invalidate today's intraday bullish bias to see a retest on last Friday minor swing low area at 114.95, maximum 114.75, which is the low of 5th of November. So that's for the euro dollar. Next up will be the sterling dollar. So the sterling dollar also broke above our neutrality limit yesterday at 131.40, and importantly, it also broke above the 20-day moving average, and also broke out above this former descending channel resistance that I drew from the high of 18th of September, indicating that the initial multi-week corrective decline on the sterling dollar may have ended. So right now it's en route into a potential minor recovery in first step back towards the 20-day, back towards the 200-day moving average and the 50-day moving average, at least in the first step. So with that, it hit our resistance level yesterday above 131.40 and did a minor pullback, and this minor pullback managed to shape a bullish reversal on a minor time scale right above that pullback line of this former descending channel resistance. Now stays to a critical pullback support, confluencing with the 20-day moving average, and graphically at also confluencing with the former congestion area at 131.40, hence making 131.40 as a key short-term pivotal support for today to flip to a bullish bias as long as 131.40 key short-term pivotal support hold on the sterling dollar. Next resistance above 132.15 will be at 132.50, followed by the all-important 133 figure level, which confluence with the key 200-day moving average and the 50-day moving average. Only a bearish breakdown below 131.40 will invalidate this bullish bias view to float it down towards a 130.80 level over here. All right, 130.85, followed by this minor swing low area that was being seen last Thursday, managed to survive on last Friday at 130.40. And so given the fact that there's a key risk event that is taking shape today for the sterling dollar, will be the announcement of the autumn budget by the UK Chancellor that will take place later today. So I'll share more about that towards the end of towards the end of today's daily dose. All right, so that's for the sterling pound or the sterling dollar. Next up will be the Aussie dollar. Still recall Aussie dollar yesterday, we have a bullish bias, and the bullish bias cleared above our first resistance level at first at 64.60, 64.67, and surpassed our resistance level as well at 64.95, as it's en route up towards 65.25/65.40. And also the reason why the Aussie dollar managed to shape this bullish breakout, also supported by fundamental news flow in today's Asia session, which I forgot to share earlier on, will be the monthly Australia CPI data. So this time around, the Statistical Board of Australia finally, for the first time, decided to disclose monthly inflation trend in Australia. Previously, they only do a quarterly update. All right. So if you look at the raw headline inflation number year on year for October, it actually rose to 3.8%, above 3.6% that was printed in the previous month of November, in the previous month of September, based on the past compilation, and also way above expectation of 3.6%. And you look at the core CPI data, they call it the RBA trim mean CPI data, year on year, it also rose above the previous month of 3.2% for 3.3% year on year October, and also above market expectation of 3%. And given the fact that 3.3% is actually above RBA upper limit of 2%/3%, so that means that more or less the interest rate cut cycle has ended in Australia, therefore supporting Aussie dollar strength on the intraday basis. So with that, given that it has already cleared this resistance level on the near term and the very short term of 64.95 over here, we will tighten our short-term pivotal support level in any pullback. So first pullback level to look out for today in the European session, if the European session get unfold, will be this level here. All right, at 64.75. So maximum will be my tighten short-term pivotal support level, adjusted one upwards towards 64.67, which is so where the price action did that sharp bullish reversal upon hitting today's Asia session low. So that being said, we will still maintain our bullish bias on the Aussie dollar. Next resistance level to watch will be the 50-day moving average, confluencing with this graphical minor swing high area of 17th November at 65.25/65.40, above 65.40, potentially may see this minor swing high area of 14th of November coming into play. All right, at 65.50. All right, so it's about 10 pips different each. Okay, so these are intraday levels to watch on the upside for the Aussie dollar. Only a bearish breakdown below 64.67 that will invalidate the bullish bias view on the Aussie dollar to see a slight back down to retest the key medium-term pivotal zone or area at 64.40, 64.25, where it managed to survive on last Friday, and also the very important key expanding wedge range support level that has been in place since 23rd of April 2025 low. Right, so that's for the Aussie dollar. Next up will be the dollar yen over here. So the dollar yen slide down as expected. So what we could see is now breaking below our first support level at 155.95, currently trading at 155.88 over here. So and also reintegrate back below this former bullish breakout line in dotted gray over here, previously a bullish breakout, and now turns into a pullback resistance level at 156.30, which is Asia session high as well. So I will tighten my key pivotal resistance level, key short-term pivotal resistance level for today, tighten it down to yesterday's rejection level during the Monday rejection level during the US session, and also almost rejected the same level yesterday at the start of the Asia session, 157.15. So using a tightened short-term pivotal resistance level on the dollar yen, 157.15, 157.15, I'll still maintain that bearish bias for the dollar yen to expose the next near-term support level at 155.25, 154.85, which is pretty key as well. Why? Because this level confluence with the 20-day moving average, and as well as the minor ascending trend line drawn from the low of 29th of October 2020-25. So only a bullish breakout above 157.15 and the hourly close above it will negate today's bullish, it will negate today's bearish bias. I repeat again, only a breakout and hourly close above 157.15 will negate today's bearish bias view on the dollar yen to see a retest at 158 figure level / 158.35. Right, so that sum up all the intraday technical outlook on the four major US dollar pair. Onward next will be the major stock indices, starting with the Hong Kong 33, representing the Hang Seng Index. So the Hong Kong 33, yesterday we flipped to a bullish bias given the very sharp rise on the index itself, thanks to the positive feedback loop that's being seen among the China mega cap technology stocks, reinforced by Alibaba newly revamped Q1 AI application. So I talked more about that yesterday. So it hit the resistance level at 226,045. So given the fact that RSI now has starts to shape a bearish divergence, so I could see the RSI slope downwards, price action go up. So there could be a pullback taking shape of it. So there could be a potential minor pullback. So minor pullback potentially was still the level to look out for will be this short-term pivotal support level over here at 25,700 level. All right, 25,700 level, which is also the swing low of yesterday's Asia session as well. Right over here. Okay, so as long as this minor pullback didn't surpass below 25,700, we'll still maintain a bullish bias. So IE will be looking for weakness, but weakness potentially should stall around at the 25,700 level for a potential minor bullish reversal candlestick that may take shape. So as long as 25,700 short-term pivotal support is not surpassed to the downside, we will still maintain that bullish bias after this minor pullback may end. Why this minor pullback may take place? Because of the bearish divergence that's being seen on the hourly RSI. Next resistance level to watch will be at 26,310, which is a very critical level. 26,310 confluence with the 50-day and the 20-day moving average. A clearance above 26,310 will indicate the start of a increased probability of a brand new bullish impulsive upmove sequence heading up towards 26,695 next in the short term. Only a bearish breakdown below 25,700 will see the much more deeper minor corrective pullback scenario unfolding, exposing the next near-term support level at 25,410, maximum 25,150, which is the minor swing low of 21st of November. All right, next up will be the Japan 225, representing the Nikkei 225. So given the fact that global stock indices has triggered a bullish animal spirits scenario. So the Japan 225 will likely follow suit as well, given the strong bullish reversal curvature that we seen yesterday during the US session, right exactly after the retest of our lower limit of the neutrality zone, which is our medium-term pivotal support, and also the 50-day moving average, and also the lower limit of this medium-term ascending channel that is still in place since 7th of April 2025 low that is being highlighted in green. So that being said, given this strong minor bullish reversal that has taken shape right exactly at this key medium-term pivotal support level, we will flip to a bullish bias for today. All right, so first support level to watch out for will be this level here. In any form of any pullback will be at 49,150, maximum 48,450, which is indeed a very key pivotal support given the bullish reversal, the minor bullish reversal that has taken shape during the US session yesterday. So as long as this surpass 48,450 medium-term pivotal support, we will flip to a bullish bias for today on the Japan 225. First resistance zone to watch out for will be the upper limit of that neutrality zone yesterday, which is so confluence with the 20-day moving average, 50,250, 50,730. A breakout above this 50,730 will increase the odds of a brand new impulsive upmove sequence to test the next intermediate resistance in first step at 51,530. All right, so that's for the Japan 225. Next up will be the Germany 30. So the Germany 30 also managed to trigger a bullish move and reintegrate back above the 200-day moving average, and as well as the former trend line, medium-term ascending trend line from the low of 19th of June in dotted gray. Previously, there's a bearish breakdown, retest above it, retest on it on the 20th of November, last Thursday, then do a reintegration back above it and also back above the 200-day moving average. So indicating that the bearish breakdown on 18th of November is a failure bearish breakdown, which I got to respect this price action over here. So with this price action turning positive, and as well as other global stock indices having that bullish animal spirit as well, supported by this US Federal Reserve potential monetary policy stance right now is showing sign of an increased probability of a rate cut in December, as implied by the latest CME FedWatch 2 odds of 80% chance, which I shared with you guys earlier at the start of the daily dose over here. So I will have to respect the positive price action on the Germany 30 and flip to a bullish bias using 23,370 as my short-term pivotal support level for today, which is the former minor swing high of 24th November. First support level to watch will be the 200-day moving average. I think as the first support level will be at 23,480. Two resistance level to take note of for today, as price action may reintegrate back above 23,665. A breakout above it exposes 23,960, which is the 50-day moving average as well. I think as a similar resistance level. So that's for the Germany 30. Next up will be the major US stock indices. Very similar on the Dow Jones Industrial Average, broken above our short-term pivotal resistance level yesterday, which is around the 46,700 level, and also cleared above the 50 and the 20-day moving average as well as we are speaking right now. So given that the RSI is now in a overbought level, all right, it's an overbought level, so there could be a chance of a minor pullback in today's US session or even the European session over here. So as you also reintegrate back above the former minor ascending channel support, previously that was a bearish breakdown, retest of it and shape a lower low due to the onslaught of Nvidia price action, but nevertheless after that it managed to recover, and right now it is reintegrate back above the minor ascending channel support level, indicating that that bearish breakdown on 18th of November is a failure bearish breakdown. So that being said, there could be a minor pullback taking shape over here, given the RSI is at the overbought level right now. So as long as this minor pullback is surpassed below our short-term pivotal support level for today will be at 46,810. We will have a flip to a bullish bias on the US Wall Street 30, representing the Dow Jones Industrial Average. Two resistance level to watch on the near term, 47,340, followed by 47,750. Which is so the former minor swing high of 3rd of November. And if you do the Fibo retracement of that previous down move from its current all-time high of 12th of November to the low of last Friday, that correspond with the 76.4% Fibo retracement and the 61.8% Fibo retracement for 47,340. Only a bearish breakdown below 46,810 will invalidate today's bullish buyer's view to see a slide down further towards 46,575. A breakdown below 46,575 will see a deeper pullback or deeper pullback at another round of choppy corrective decline to retest 46,010 next. So that's for the US Wall Street 30. Next up will be the SPX 500. So SPX 500, yesterday we were neutral. It broke above the upper neutrality limit and also cleared above the 50 and the 20-day moving average as we are speaking right now. So given the fact that RSI is at a overbought level and is at the most overbought level since 12th of September. So given the fact that a rather extreme overbought level on an hourly basis, so there could be a chance of a minor pullback taking shape. So minor pullback, first support level to watch will be 6,720. So as long as 6,720, maximum 6,690. So that will be my short-term pivotal support level. So 6,690, if we do the Fibo retracement of this potential 5-wave up, 1, 2, 3, 4, 5. So that also constitute with the 50% Fibo retracement. So as long as give me, let me do the retracement again. Okay, it's 38.2%. 38.2%. All right, 50% is at 6,655. So as long as any minor pullback managed to hold above this short-term pivotal support level at 6,690, we will flip to a bullish bias on the SPX 500. Next resistance level to watch 6,830. A breakout above 6,830 potentially exposes 6,880 next. All right, only a bearish breakdown below 6,690 will invalidate today's bullish bias view to see a retest at 6,655. A breakdown below 6,655 will see a much more pronounced or revive the bearish bias corrective declines scenario again, retesting 6,570 and even last Friday minus swing low area at 6,540. So that's for the SPX. Next up will be the Nasdaq 100. So the Nasdaq 100 also did a very strong push up, cleared above the 50-day moving average and so cleared above our upper neutrality limit yesterday. So given the very strong bullish push up on the Nasdaq 100, so RSI is now at the overbought level as well over here. So there's a risk of a minor pullback. So minor pullback could come close to the 50-day moving average and very close to the graphical former intraday minus swing high of Tuesday during the of Monday during the US session. Now turns into a first pullback support level to watch, 24,940. Maximum of that pullback to maintain this ongoing bullish bias will be my short-term pivotal support level of the Nasdaq 100 at 24,760. So as long as this minor pullback did manage to hold at 24,760 short-term pivotal support level, we will have a bullish bias of it. Two resistance level to watch on the intraday basis will be 25,290, which is very close to the 20-day moving average, followed by 25,455 for today, which is the former minor swing low of 12th of November, broken down now turns into a pullback resistance level. And if you do the Fibo retracement of that sell off from the current all-time high of 30th of November all the way down to last Friday swing low, this 25,455 also confluence with the golden, very closely with the golden ratio at 61.8%. All right, so that sum up all the intraday technical outlook on the major stock indices. Let's now touch on the commodities market, starting with gold XAU/USD. So gold yesterday we flipped to a bullish bias, holding up with 4,105 as my short-term pivotal support level. Price actually indeed do a U-turn after almost a retest during the US session where it printed a low of 4,129 over here. So that being said, right now it managed to clear above this first resistance level at 4,155 over here. So we still maintain that bullish bias over here, but I don't want to tighten my pivotal support level to 4,155 because it haven't cleared above 4,203. So unless we have a clearance above 4,203, then I will tighten it towards 4,155. So for now, I'll be still using 4,105 as my short-term pivotal support. Maintain this short-term recovery for gold XAU/USD towards the next intermediate resistance level at 4,203. Above it sees 4,267 next, which is the 76%, 76.4% FIBO retracement of that previous sell off from the all-time high of 20th of October this year to the low of 28th of October 2025. Only a bearish breakdown below 4,105 will invalidate today's bullish bias view to see a choppy minor corrective decline to retest the 20-day moving average again. That managed to which is so the minor swing low of 20th of November all the way up to 24th of November at 4,038. So that's for gold XAU/USD. Lastly will be the West Texas crude oil. So the West Texas crude oil tumbled as expected, hit our first support level 57.54 and printed a slightly lower low at 57.31 over here. So 54/31. All right, 54/31. All right, so no change given that it hasn't really clearly broken below 57.31. I do not want to tighten my pivotal resistance level. So first resistance level to watch out for today, where RSI now managed to bounce off from the oversold region, hasn't really hit the overbought level yet. There could be a further bounce up towards yesterday's European session high. All right, yesterday's European session high at 58.73. So still using 59.32. So as long as this bounce is surpassed above 59.32, first resistance to watch with 58.73, still maintaining that bearish bias for a retest of 57.54/57.31. That is yesterday's low. A breakdown below this level potentially see further weakness to expose the next intermediate support level at 56.8, which is the swing low area of 17th of October and 20th of October, and also this complex minor range configuration that has taken shape since 17th of October as well. Only a bullish breakout above 59.32 will potentially see the West Texas oil price action reintegrate back up towards the upper limit of this sideways complex range configuration, with the next resistance coming in at 60.40 level. All right, so that's for West Texas oil, and also sum up all the intraday technical outlook on the broad-based cross asset classes. So before we go, let's have a quick look at the economic calendar. What are the key data to look out for today? Okay, so at the start of the European session, do take note of this UK autumn budget that could come anytime at the start of the London opening hours. So that could be around Singapore 5 p.m. to 6 p.m. over here. So that could potentially influence the sterling pound. So the sterling pound has fallen quite a fair bit in anticipation of this autumn budget. So why the sterling pound has fallen? Because the UK Chancellor wants to actually balance the fiscal deficit in UK by announcing tax hikes to various category. So that causes the pound to weaken, but that has already been priced in. So perhaps on the announcement of this autumn budget, as long as it came within expectation, the pound could still remain firmer on the backdrop of a much more dovish Federal Reserve rate cut expectation right now. So that could come in around 5 to 6 p.m. Singapore time. And as we head into the US session over here, so for today's US session, we will have the release of the initial weekly jobless claim data. So that is a much more erratic number because it's a weekly basis. So this weekly jobless claim data will indicate the health of the US labor market, both initial jobless claim and continuation of jobless claim data for the week of 22nd of November. They'll be out at 9:30 p.m. Singapore time, so something to look out for as well. Then thereafter, we have the weekly crude oil EIA crude oil stockpile change, so that could influence the movement of the West Texas crude oil. So that will come in at 11:30 p.m. Singapore time over here. So then on 1 a.m. Singapore time, early Thursday, we have ECB President Lagarde's speech that could influence the euro dollar and the euro crosses over here. All right, so that sum up today's Daily Dose of Market Insights. I'm Kelvin here signing off. I wish you all a great day ahead, and we shall speak again tomorrow. Thank you.